Welcome to another show of Invest Africa. On our show today we have Abdel Romatali, who is the Managing Director of the GFA Insurance. Abdel, welcome to our show.
Thank you.
Tell me, who is Abdel Romatali?
I did my university studies in London and I graduated in financial services. I also undertook some studies in insurance as well as travel and tourism before coming back to Mauritius. So I came back in 2001, joined the family business founded by my father. So been in Mauritius for nearly 13, going 14 years. Started in administrations, went around in the company, marketing, IT, underwriting claims, and was promoted to Deputy Managing Director in 2005, and recently promoted to Managing Director after my uncle, the chairman, retired as chairman, and my father stepped up as non-executive chairman of the company.
Congratulations, Abdel, for being promoted as a Managing Director after having worked up in different sectors of the different aspect of the insurance business. Tell us about the Mauritian insurance sector as it is today.
In terms of contribution to the economy, I think the insurance sector contributes to about 3% to GDP. It's made up of about, I think, 18 companies. Since 2011, insurance companies have had to split up. So there are those doing only life and pensions business, others doing general only business, about 6 or 8 of them.
Is that healthy for an economy like Mauritius, and what are the risks of having
it is very unhealthy.
That skewedness?
It is unhealthy, and it's something I've been trying to fight against since my return to the country. I was quite happy with the motto of the government of democratization of the economy, and I think to democratize the economy we cannot go without looking at the financial services sector as well. So it's unhealthy because if you have leaders having guaranteed share of the pie, of the business, they wouldn't want to innovate, and customers in the end are the one who lose out because lack of innovation and they are not able to shop around. Many of the conglomerates in Mauritius, well, they have the banks, they have their own insurance companies, they have their own car agencies, they have their own leasing companies. So what very often happens is when you want to buy a car, you go to Group X, Group XYZ. They will offer you the leasing XYZ. They will also offer you or nearly coerce you to take insurance with their own insurance company XYZ. So the money goes within that
particular company,
that group. So I think it's unhealthy.
And it's unhealthy, but also risky. And what do you sort of propose? I mean, already the government has split the two sectors, the life insurance and the non-life insurance. That's a starting point. But what else would you like to see happening to make it more healthy and less risky?
The splitting was mostly due to follow what other developed jurisdictions have done. Many countries, in many countries, but not all of them, you have life business. You need a separate license and separate capital for life and non-life. Unfortunately, in the late 90s and early 2000 as well, we've had a couple of companies collapsing in Mauritius, composite companies. So what had happened was their motor portfolio didn't perform well, and the company went bust because of financial problems in the motor portfolio, whereas their life portfolio was doing well. But unfortunately, it's the same company, so when the company goes in administration and liquidation, it's the whole fund that is put into liquidation. So 2-3 companies closed around late 90s and around 2000 and 2001. So that was the reason for the splitting. There was a financial services assessment program done by the World Bank, and a consultant from the World Bank came over called Dimitri Vitas. So he came, he met a few of the players, and I insisted with the Financial Services Commission that I also made the guy to brief him properly of what the position in Mauritius is. So eventually in his report, he made a comment that the Mauritian market is an oligopolistic one. The Mauritian insurance market is an oligopolistic one. The problem is, he made that comment, I think, in his report around 2003. And where he explained that about 80% of the assets are owned by 2 or 3 companies, 70% of the turnover again made up by 2 or 3 companies. More than 10 years down the line, it's still the same. Nothing has changed, nothing has progressed. I also, not alone, but with the help of a few people, I've got a good friend who was at the Institute of Consumer Protection, Mossadegh Saebdin, and also some other members in the press. I successfully lobbied that so that freedom of choice of insurance, a clause, is included in the Insurance Act 2005, enacted in 2007. There was a strong lobby. I don't need to tell you that from the bigger guys to have that removed. But there are similar provisions in the South African Insurance Act and Canadian Insurance Act and other jurisdictions as well. So eventually we managed to have that kept in the law. Unfortunately, regulators and government have been a bit slack in applying that section of the law and making sure that this helps to democratize the insurance industry.
This incestuous business integration you mentioned earlier, I would call it incestuous, because it's everything linked to the same company. Is that giving our consumers an unfair deal or a bad deal?
Definitely, because like I told you, a particular scenario where you're buying a car in the same group, you have the leasing, the bank and the insurance company within the same group, and very often they will not inform you of your freedom of choice of insurance. They will nearly coerce you to take the insurance within their own company or 2 or 3 companies, so you're not really having a good choice, a great choice. Whereas actually your choice is between 8 insurance companies. So the customer doesn't have much of a choice. Now, obviously in insurance business, cheaper doesn't necessarily mean value for money. However, if 8 insurance companies were competing for that business, one, the consumer would have probably obtained a better deal in terms of premium, a better deal in terms of add-on services, perks like emergency roadside assistance, passenger cover, and so on. Maybe no excess for 1 year or 2 years. So the customer is not having a free choice, not having a free choice, the customer eventually doesn't have a good deal.